Welcome back to the Wealth Builder podcast. My name's Nick Donato, and I'm a financial advisor at Guidance Financial. In today's episode, I'll be joined by David Markovski from Optimized Accounting. He's a tax specialist and here to discuss our topic for the day of family trusts. As a financial advisor, a lot of clients have come to me telling me that their friends have family trusts and their friends have told them that they should also have a family trust. In some instances, that might be valid, but in other instances, it might not be appropriate for the client. So today we're going to take a deep dive into trusts and discuss what they are, the benefits, the pitfalls, and debunk a few myths around these types of structures. So welcome in, David. Thanks for joining us here today.
Thanks for having me, Nick. I'm excited to be on the pod.
No worries. So you work with your clients day in, day out, and with these types of structures every day, helping clients set up and manage them on an ongoing basis from a tax perspective.
Yeah, and you've touched on an important point where we do get a lot of questions around family trusts and whether they're suitable and appropriate for your needs. So where we see family trusts come into play is usually around either investment or operating your small business through there. So a family trust is a separate vehicle that can operate a business or can be used to make investments in assets. And it has the flexibility to distribute either gains or proceeds from the sale of assets or earned income or derived income out to the beneficiaries. The beneficiaries are the recipients of those income and assets from the trust.
Can anyone be a beneficiary of the trust?
Most people can be a beneficiary. There are some excluded terms, and it does depend on the actual trust deed, and the trust deed is the document that governs the rules of the family trust. But most people can be a beneficiary of a trust.
So the trust deed's basically the rule book of what the trust can or can't do. And that's, I guess, the initial establishment is by having this trust to say that this structure exists and it's now, these are the rules that it has to abide by.
Yeah, that's right. It sets out all the terms from the initial outset of how the trust is to operate, why it operates that way, and who the nominated persons are that play each of the roles in the family trust.
What are the different roles in the family trust?
So the different roles are the trustees. The trustee is the person that operates and acts on behalf of the family trust. So this is the person where you'll see terms like such and such as trustee for the family trust. So this is the person that legally directs and operates the family trust, signs on its behalf, and makes the decisions of the trust. Now, the trustee needs to act in the best interests of the beneficiaries. So quite often where you see a husband and wife using a family trust as an investment vehicle, one of them may be the trustee, and it's likely that both of them are beneficiaries of the family trust. So the idea is that the trustee uses the family trust as a vehicle to make their investments on behalf of those beneficiaries being themselves.
All right. So the trustee is the one that makes the financial decisions around what investments to have and what they should buy, how much they should pay out, and in terms of income and dividends and distributions from the trust. And then the beneficiaries are those who receive the accounts. So in a lot of instances, you see husband and wife as the trustees and the beneficiaries. And then in some instances, their kids might be the beneficiaries to get some payouts, or the grandkids even might be a beneficiary to get some payouts. And I guess we'll go into more of that in a bit around the different advantages and whatnot involved around having different people as beneficiaries. But I guess that holistically is what a trust is, around having a vehicle to invest in. So, David, I guess I hear a lot of times when people aren't familiar with trusts, a trust only for rich people.
Well, it's certainly true that a lot of rich people and wealthy people do have trusts or family trusts in play. It's not a case that they're solely for rich people. It really comes down to what you're looking at in front of you, so what your personal circumstances are, and what you were trying to achieve with your family trust.
And what are the advantages of having a trust then?
So I guess I can rattle off a whole bunch of different pros and cons, but if I was to talk to a couple of specific examples, I'm working with a small business owner who was traditionally structured as a sole trader, so running his business through his personal ABN. So he was making about, or is making about $150,000 each year and paying personal tax rates on that income. So earning 150 grand a year, your income tax and Medicare liability each year would be just shy of $40,000. Now, we saw this individual as a perfect example of someone that could be restructured into operating their business from a family trust because their family circumstances dictated that they'd get enormous benefit, in this case, tax savings by operating through a family trust. So this individual were able to get some exemptions in play to restructure their business without triggering any kind of capital gains tax. They're now operating from a family trust, still making 150,000 per year. This individual is the husband who's the only working person in the household, and the wife is not earning any kind of income, and they have three adult kids that are all going to university. That only one of them is working a casual job, so there's not too much income there in their personal names. What this has then allowed them to do is when it comes time to prepare their tax returns and they prepare the distributions that come out of the trust, the dad has elected to use the family trust to distribute $20,000 to each of the three kids. So that's totaling up $60,000 of distributions there. The remaining 190,000 has been distributed by 45,000 to mum and 45,000 to himself. So the effect this has had is instead of having 150,000 of personal income assigned to his personal name from when he was operating as a sole trader and paying 40,000 in income tax, now between the family, the three kids are actually not paying any income tax or Medicare liability, Medicare at all, and mum and dad are paying around $5,000 in tax each. So in total, their new income tax liability between the family group on 150,000 of income is 11 grand. So it ends up being an annual tax savings for them of $30,000.
So the biggest benefit of having one of these structures is the way you can plan your tax and ultimately potentially save yourself on a decent amount of tax in your personal name.
Definitely. I can certainly appreciate that you have to assess this on a case by case basis. But that's one example of where it's worked really strongly for tax saving purposes.
So I've got two kids myself, a 1 year old and a 4 year old. If they were beneficiaries of my family, my hypothetical family trust, can I distribute the 20,000 to them or funds to them, or what do they have to be adults? How does that work?
Yeah, great question, Nick. And one of the key differences between the example I've just sort of suggested there is that in the example, the kids were over the age of 18. So where you've mentioned there that your kids are classified as minors, they get hit with a penalty tax rate if they receive distributions from a family trust. So we can distribute $416 to them tax free. Between $416 and $1,307, the kids are actually going to pay a surcharge tax rate of 66% and then 47% on anything above $1,307. So you can see quite quickly that the kids' tax rate is above or mirroring your top personal tax rate. So it cancels out any benefit of distributing to minors beyond $416.
So they're probably not getting the tax savings if they're going to my kids. That's all right. So I guess in that instance, it would be a case by case basis if it was a viable option for myself or for someone in that situation. There's a couple of other benefits of a trust around asset protection and succession planning. I guess within a business, if we're running a business through a family trust, do you want to touch on asset protection and what that looks like?
So while tax savings are definitely a big pro of utilizing family trust structures, another benefit is certainly asset protection. So this is where you have individuals that aren't necessarily looking to build enormous amounts of wealth in their personal names, but rather create it through a structure like a family trust where wealth is generated separate to their personal names. So if you're operating a business, for example, in your personal name, you're out there dealing with customers, creditors, making promises and guarantees, and the ordinary risks that come with operating a business. So, one common strategy we'll have here is you have mum operating a business through her personal name, and you have dad as the trustee of the family trust, who's then pushing the wealth across and investing it via the family trust to build wealth that way. So, where mum is exposed to the ordinary risks carried on with the business, that's all linked to her personal assets and personal name. Dad sits separately to that as the trustee of the family trust, where he can invest via the family trust, build up the family's wealth that way, and keep it out of her personal name. So, if the worst were to happen and insurances weren't in place with mum's business and creditors were to come after assets, they're generally limited to what's linked to her personal name. And there are exceptions to that, but generally speaking, in absence of fraud or negligence or some other nastier things, then her assets are protected, limited to what she actually has in her name.
So outside of a small business and the asset protection available from a small business, I guess as a parent, one of the biggest concerns, I guess mine are still quite young, but as a parent, one of your concerns might be I build up these assets that one day are there to help my kids buy a house or live their life, whatever that looks like. But then they get into a relationship that's not too favorable. And then their partner tries to get at their finances and there's a bit of a dispute and not an amicable breakup potentially. Does a family trust help with that style of asset protection, like avoiding them losing the money to this person? Or is that just for a small business asset protection style?
There's certainly structures that can be put in place to protect family wealth. What's very tricky when it comes to divorce is divorce courts will reach through most structures or at least allow for it, especially if the ex-spouse in that case has a quality legal team, then they'll be able to reach through most structures and assess an asset pool that way and divide up what's been created there. So divorce is a very tricky one where it's definitely prevention is better than treatment. Once it sort of reaches that stage, it's very hard to protect wealth through any kind of structure.
Gotcha. So mainly through asset protection is mainly for business owners and people trying to delineate themselves from their business to protect their liability and whatnot. The other 2 points that I would raise is it provides you with a bit of flexibility in terms of tax planning, being able to provide to the beneficiaries and save yourself some tax. And in that era, we can also start other structures such as what we call a bucket company to help you save tax as well. And the final piece that I personally think is a great tool is succession planning. Again, these days we are seeing a lot of older clients wanting to pass their wealth to their kids, again, their grandkids and whatnot, to provide with a bit of family wealth. So a family trust is a great succession planning tool. Would you agree with that, David?
Absolutely. So when it comes to succession planning, we're getting this question a lot more and more as well. Are there ways to get assets to my kids or to have my kids take over my business without triggering capital gains tax and losing part of it along the way? So ordinarily, if you've got assets in your personal name, they would form part of your estate upon passing, and normally there's capital gains that's triggered at some point throughout that process, meaning there's a haircut to the kids, inheritance basically. So investing via a family trust sits outside of your personal name. Because it sits outside of your personal name, it also sits outside of your estate upon passing. So if we call back to the family trust deed, the family trust deed will govern what happens in the event that a natural person does pass on, and who assumes the roles to take over governing the family trust.
And the family trust deed is the rule book, quoting back, the family trust deed is the rule book of the trust.
That's right. So documents and governs what happens there. So because a family trust sits separately to yourself as an individual, if you do pass on, those assets do continue to stay invested because the family trust still exists. It's more so the trustee now needs to be replaced if you were the individual trustee. And the trust deed documents who is allowed to then step into those roles. So it's more so an administration process that can be quickly or more promptly executed upon to ensure that the family trust can continue being guided by a new trustee. So you might have your trust deed that stipulates that your kids are the ones specifically to take over the trustee role and be appointed as trustee should you pass on. That then gives them the ability to continue managing the affairs and continue administering the family trust in a way where the ownership of the assets owned by the family trust doesn't change and hasn't triggered a capital gains event.
So great for succession planning, great to pass on to whoever's left when you're no longer here, or as you're trying to pass assets to children potentially to help them out. Again, with house prices and everything going the way it is in the future, it might be a good tool to be able to help them out in some form. And within a family trust, there are also other investments. It's not just set up for someone that owns a small business or a business. We can invest in multiple different assets, from property to shares to term deposits. There's a multitude of assets that you can invest in. Any investment that you can invest in your personal name can be owned via a trust as well. And I guess in the long run, that helps with the tax planning, and that can help to potentially reduce capital gains tax in the future. So there's a fair few benefits there as well. So with all of these benefits that we've chatted about, a trust sounds like a great structure. So why doesn't everyone have a trust? What are the downsides? Why doesn't everyone have a trust?
Well, there's not too many downsides, to be honest, in where it makes sense. It's more so when you look at your personal circumstances and what you're trying to achieve, is there going to be a benefit to it on the back end of what you're doing there? So there's obviously, the setup costs to actually get one going, and they can be, 2 to 3 thousand in their own right as a bit of a one-off. Then there's the ongoing administration. So separate to your personal tax returns, a family trust would need to submit its own personal tax returns and most likely prepare financial statements that document the ins and outs and the earnings and the expenses of the trust and where its financial position sits. So there's more administration that goes along with it. So some people prefer to just not have the added cost and keep things simple, but then you're potentially foregoing the benefits of of investing through a family trust structure. Now, typically where it wouldn't make sense to have a trust is if you weren't sort of looking at committing to making investments on an ongoing basis, or you weren't throwing any kind of significant capital towards investing, and you wanted to keep things simple. Then it's likely that the extra administration isn't necessarily worth it, or the additional costs outweighing the potential tax savings or benefits that the family trust offers.
I guess before you start even investing, you've got to determine if the structure is appropriate and look at all the other structures out there, from super to companies to your personal name even. Throughout this series of podcasts, we'll have a further chat around all the different structures of investing and where to even start investing. Again, with family trusts being one option to structure your investments to use as a vehicle. The other side of things, or the other disadvantage, so to speak, would be that the legal implications, and if there's some mismanagement of the family trust, um, as you said, the trust has to pay out the income every year, and that has to be managed through your tax return and get some help from an accountant. And there's some risks involved there if it isn't managed in the appropriate manner. Obviously, if you go to a trusted accountant, I'm sure that they will manage it appropriately for you. But at the end of the day, you've just got to be aware that if one was to set up these structures, there's risks that do fall back onto the trustee or the owner or the controller of the trust. So I guess there's a couple of advantages and definitely a couple of things to consider when investing via trust, through the costs and the major advantages being the tax advantages involved in a trust. Is there any additional tips or myths that you want to debunk around family trusts, being the expert in the area, David?
I used to get many people coming to me with you know, advice that they got, from their friends at the barbecue on the weekend or from the pub at the end of the day, saying, so and so has a family trust. Why haven't you set me up with one? And it's important to note that just because you can set up a family trust doesn't mean you should. And it's important to get specific advice and talk with an accountant or a tax advisor about what you're actually sort of planning on doing, so they can work out with you what the pros and cons of setting up a family trust and making your investments via a family trust look like for you.
Yeah, I get that all the time. As I said off the top, we get a fair few clients come in and say, why don't I have a family trust? My brother has one, my sister has one. Why shouldn't we have one? And as you said, it's a person by person basis. So in some instances, yeah, you should have one, and we will recommend it and get David to set it up for you. In some instances, it might not be. Everyone's personal situation is very different from your personal situation. Everyone's unique and has their own reasonings around setting things up and establishing investment streams and finances and whatnot. So that's one thing to definitely consider, and it'd be definitely to get some professional advice if you were going to go down the path of establishing a trust, or if you wanted to look at what a trust means for you. Did you have any final comments to add around the topic, David?
Well, one of the other things I was going to mention is I've started getting snippets from clients where they're sending me screenshots from ChatGPT that's making recommendations, or they're sending me TikToks or YouTube shorts, and there's online finance gurus on there sort of recommending this and that, and they skip over all the nuance of your personal circumstances there. So I just can't stress enough that it's important to have that open conversation with your tax advisor to make sure that these types of things that are sort of being started online are actually going to benefit your specific cases.
100%. I like using ChatGPT. I sit on my phone and scroll through the TikTok reels and whatnot every now and then. But as you said, it doesn't take into account your consideration. So everything that these people are saying, everything the computer's saying, might be correct for one person and incorrect for another. So it's definitely a warning sign, and just sense check the things that come from social media and even chat GPT these days. Well, that's a wrap on today's episode of the Wealth Builder podcast. Thanks to David for joining me today. He'll be coming in on a regular basis, so stay tuned. We'll be chatting about capital gains tax together next, so that'll come out in a couple of weeks' time. So stay tuned for that. You can also find him at Optimized Accounting for all your tax and accounting needs. So feel free to reach out to him if you need anything. And yeah, thanks everyone for listening along as well. If you like today's episode, feel free to leave us a review or share it to someone that you think might benefit from our conversation today. And I look forward to bringing you the next episode in a fortnight's time. But until then, have a great day.